back at 1 o'clock with our next keynote speaker, Reid Brewer. He'll be talking about AOCI, which is Accumulated Other Comprehensive Income, or now as more people are starting to call it AOCL, Accumulated Other Comprehensive Loss. He'll be talking about those marks in bank M&A and intangible book values. So please either stay with us, just leave us on, or you can leave and come back in through the same link that you came in this morning. All right, very good. Thanks you so much. Okay, hello, hi everyone. Welcome back. Thank you for coming back. I'm Julianne. Ian is to my right on my screen, no worries on yours. It's my pleasure to announce our second keynote speakers, actually. As you know, AOCI marks, which are the fair value marks in bank securities portfolios, has been a real impediment to bank M&A, to consolidate. And you heard from Mike Godbey about how important consolidation is in realizing real value, sometimes in the stock. And so this has been an impediment, but it hasn't completely stopped bank M&A. And Reid Brewer, who's our guest speaker from Piper Sandler, is an investment banker who's had quite a bit of success in getting deals done in spite of this interest rate environment where the securities portfolios are taking heavy marks. And he's joined by Matt Brunner, who works in the balance sheet strategy group. I might have gotten that group wrong, but you can correct me when it's your turn. Very good. So I'm going to pull up your slides and go ahead and start. Thank you very much for being with us.
Well, thank you, Julianne, and I very much appreciate the opportunity to be here and to speak with you all. And thank you for the kind words. I'd love to take full credit, but I happen to have great clients, so you know, the M&A success is not all mine. But let's see here. Are we ready to? Can you all see that? Are we set to go? Perfect. Well, again, thank you very much for the opportunity to be here, and I'm going to try to get through this presentation here with enough time for questions, about 10 minutes or so at the end. So I thought what might be the best place to start would really be with the key themes that I would hope that you would take away from this presentation here. Oh, and by the way, Julianne, if there's any follow-up, feel free to distribute this presentation to anybody that might want it. My contact information is in there, so feel free to reach out at any time on anything.
Okay. I think we'll link it to the website afterwards.
Perfect. Thank you. So look, I think as a good place to start, and Jillian, you can maybe go to the next page, one more. Perfect. I just want to give the key themes here that we're going to go through in the rest of this presentation. And I think the first, as I'll walk through on this slide, is that the banking industry is extremely healthy and in a great position right now. Q2 results, as well as trends that we're seeing in third quarter, are all very, very positive, with a lot of tailwinds and great momentum. For banks, you know, and in the rising interest rate environment currently, there is quite a bit of noise being created and a fair amount of uncertainty, particularly around three items. I think, you know, the first is AOCI, and how should we think about AOCI from the AFS portfolio, and how does that impact valuations? The second would be, you know, what is the impact on M&A volume and valuations? And then the third is, what is the long-term impact on margin? And we'll go through the first two. I think the third is, given the strong asset-sensitive position of the industry, we here at Piper Sandler feel that over the long term, a rising interest rate environment is going to be very beneficial for the earnings of the industry as a whole. The third theme here is that size continues to be a key driver of scale and market valuation for the industry. So larger banks earn higher return on average tangible common equity for a variety of reasons, and as you'll see, are more valued more highly in the public markets by public market investors. And as a result of that, M&A, which is probably the most efficient way to drive earnings and scale, remains a key focus for banks and in the banking industry. Year to date 2022, volumes and deal sizes have slowed, largely as a result of macroeconomic concerns and kind of the result on or the resulting impact to buyer stock prices or industry stock prices as a whole, which have tracked the S&P down, I believe, around 14% year to date. And then the third is that, or the final theme here is that the rapid change in interest rates, call it year to date, fourth quarter to year to date, has impacted M&A discussions. It has introduced a certain amount of uncertainty in how to consider valuations, how to consider deal math and deal metrics. And as a result of that, there has been a little bit of an evolution about how to frame these deal metrics in the context of a rising interest rate environment and interest rate related mark-to-market marks. So that was a long-winded introduction, but hopefully we can touch and support on each of those topics. The first here, oops, sorry, go back one more, which is, so Piper Sandler covers 215 banks in our research universe. In second quarter, 65% of those banks beat our earnings estimates for what they were going to be, and 74% of our bank coverage universe had their earnings for 2022 and 55% for 2023, their earnings estimates increased. So we are seeing very positive trends in the industry. Drivers for that have been net interest margins, which have outperformed by 13 basis points above our expectations, stronger loan growth than expected, and then credit quality remains very, very strong, and banks have more and better capital than they have ever before. On the flip side of all of that, the rising interest rate marks have driven book values down. So tangible book value or tangible common equity from the fourth quarter to the first quarter declined 7%. And from the first quarter to the second quarter declined an additional 3%. So net since the end of the year in 2021, although earnings have been great and the market, and the industry is very strong, tangible book value has declined about 10% as a result of rising interest rates and the OCI mark on the AFS portfolio. Okay, next page, please, Julianne. Here is an overview of where we are expecting the rate environment to be. So on the two top left charts, you can see the evolution of the Fed policymakers' expectations. Each dot is a different Fed policymaker. You can see the evolution of their expectations for where rates are going to be in 2022, 2023, and 2024 and thereafter from March to June. So as you can see in the June FOMC, Federal Open Market Committee dot plot, in 2023, we're seeing expectations that the rates will be, call it, 3 3/4 up to 4 1/4, with them starting to drop again in 2024, with most expectations that call it 3 1/4, and then in the longer term run rate at about 2 1/4 to 2.5. So continued rate raises, expected through 2023, and we're starting to see some expectations for rates being cut again in 2024. And on the top right, you can see the most recent yield curve there, which is September 2022. I guess that's an orange. And while the short end of the curve has risen, we are seeing some inversion of the curve there in the middle. And then it's, a fairly thin spread kind of between that, 2-year and 30-year, really, if any. So fairly challenging interest rate environment from the yield curve at the moment, though absolute rates are higher. Next page, please. Despite kind of all the positives that I went through with the banking industry doing better, driven by margin as banks were able to redeploy liquidity and to higher yielding securities and better growth, et cetera. Bank stocks year to date are down about 13% relative to the S&P, which is down about 15%. So even though if you kind of look at the chart on the left-hand side in the middle, since after recovery from COVID from January 2021, banks rose up towards, the middle of the year, the beginning of 2022, which is in the middle of the chart. And then as we've had sort of these macro macro and recessionary driven fears of slower growth, potential credit issues, etc., you are starting to see, bank stocks fall in line with the S&P. That's important. The reason that's important, really, for purposes of this conversation, is that bank M&A and M&A valuations are really driven at the core by where the buyer's stock price trades. There's something called a pay to trade ratio, which is, I always have to think about this. The pay to trade ratio is the percentage of the buyer's stock valuation that they are willing to pay in an M&A deal. So if if a buyer trades at 100% of tangible book value, and they pay a seller 90% of their tangible book value, that pay to trade ratio is 90%. So the long-term run rate for pay to trade is 95%, give or minus, and that's a fairly consistent number over the last, I want to say, like 20 years. I'd have to go back to my chart, but it's almost a flat line despite where the stock markets have been. So the biggest determining factor in M&A valuations is the buyer stock price. Typically, buyers are willing to pay about 95% of their own premium. And as you see here, when bank stocks are down 13%, theoretically, M&A multiples would be down 13%. So that's caused a little bit of a pullback in deal volume, amongst other things. Next page, please, Julianne. Here's an example of what I was saying before about scale and public market valuation. So on the left-hand side, that chart with the bars and the lines and the gold line, that is banks by asset size, and you can see the asset size groupings on the bottom left, or excuse me, under the bar charts. And the gray bars represent the price to tangible book value for each grouping. So as you can see, as banks get bigger, it's linearly, correlated to higher price to tangible book value multiples in where they trade in the public markets. Bigger banks trade better. And the reason for that is the other charts on this page, which really show that as banks get bigger, if you take a look at, for instance, on the top right chart, as banks get bigger, return on average tangible common equity gets higher. And part of that driven by efficiency ratio on the bottom right, which gets lower. So in the current environment, investors in public market banks are rewarding scale and rewarding size as they're able to benefit from being able to invest in things like digital banking, being more competitive in a competitive loan environment, have differentiated business lines, all of those types of things, which I could talk about for a year, but we'll keep moving through. So next page, please. Thank you very much. This is an example here of our M&A activity and the slowing that we've seen, which is really kind of unbelievable since the beginning of the year. If you look at the chart on the right-hand side, the blue boxes or the blue bars represent the deal value, right? So for each quarter, the amount of deal value that's announced. And the gold line, again, represents the number of deals. And then in the box below where it says average deal size, that's the average deal size, which is the blue number divided by the gold, number of deals. And as you can see, once we started to get into this more complex rate environment, recessionary fears started to really rear their head in the fourth quarter. You could see the pretty sudden drop off of number of deals, as well as the size of deals. So banks are taking less concentrated risk, doing smaller deals, and just trying to play it a little bit safer in a little bit of an more unknown environment. One other thing that sort of goes along with this is that there seems to be a little bit more elevated regulatory scrutiny on larger M&A transactions at the moment. So I think as you talk to buyers, they are fairly hesitant to announce really large M&A deals at the moment. Another thing that is driving a sort of a slowback, which we'll get into in a little bit more detail in a moment here, is that while there are a lot of ongoing M&A discussions, this still remains a really main focus, right, for banks, because they want to get bigger, they want to get scale, they want to get those higher public market valuations. They continue, the discussions have sort of slowed because the higher interest rates have reduced sellers' tangible book value per share or tangible book value because of AOCI. And in addition to that, there's also affecting something called purchase accounting. And what we'll get into in a minute here is that when banks are, when banks do an M&A deal, the seller's balance sheet is marked to market through purchase accounting. And mark to market includes things like credit marks and other items, but it also includes things like rate marks, which historically have not been that big of a consideration, whether it's been because it's been a flat rate or a non-changing rate environment, or because rate increases or decreases have been fairly slow. They haven't been, it hasn't been any drastic changes. However, we are in a really unique environment where rates are rising a lot and quickly. So those tend to have fairly outsized impacts on the rate marks, which are causing the deal metrics that buyers and sellers and investors like yourselves all use to evaluate the merits of a deal from a financial perspective, right? So there's the strategic perspective of announcing an M&A transaction. And, Hoppy Cole did a great job earlier of describing all the strategic types of benefits that he looked at when he looked at Heritage transaction, which I was fortunate enough to be a part of. And, all of those metrics really make all of those rationale and those reasons make an enormous amount of sense to support bank consolidation when the cultures fit, when the markets are accretive, all of those things. And in a time when bigger banks are valued more highly. However, you want to make sure that you announce M&A deals within certain parameters that are generally accepted by the street and by investors. And I'm actually going to ask Julianne if you could maybe, I think, switch, I forget the number, go maybe 2 pages down. I've kind of got onto a tangent. So
This one?
No, one more. Oh, I've kind of talked about all these already. Maybe one more. How am I doing on time?
Well, I think, I'm sorry. Yeah, you're doing well. Yeah, let's definitely get to how buyers think about the AOCI marks.
Sure. So I think this is where I wanted to land. Thank you very much. So now that we've entered this time when buyers and sellers are negotiating M&A transaction and are trying to incorporate rate marks that are far more significant than they have been in the past, particularly very recently, there's a question of how does this impact the value to the buyer, right? First and foremost, the value to the buyer. And then the second is, how does this impact the metrics that we use as guardrails to, from a financial perspective, evaluate the transactions and announce them to the street, as we like to say, right, through investor presentations and all these things. And I think what is important to understand when you think about rate marks, when you think about those two questions, is rate marks are accounting driven marks. They do not impact they mark things relative to external factors that are happening in the interest rate environment. They do not affect the credit quality of that security or impair that security or anything like that. It is strictly an accounting mark, or the cash flows of that security. It's an accounting mark that marks it to market, right? But what it then does is it amortizes that mark back through earnings over the life of the security, right? So what happens is in M&A is when you take mark to market adjustments on day one, that affects your tangible book value. And in this rising rate environment, and generally rate marks in this rising rate environment, generally what rate marks will do is they will lower the value of that asset which will then lower the equity on the seller's balance sheet, which will make the equity that the buyer is acquiring lower and increase tangible book value dilution. However, unlike things like credit marks, because a rate mark is just an accounting mark to market and a rate mark to market, that rate mark is then amortized through earnings over the life of the security. So it increases the earnings for the buyer on a go-forward basis. So as a buyer, what you think about is you would apply rate marks to AFS securities, you would apply rate marks to loans, you would apply rate marks to rate-driven deposits, and those generally are CDs and broker deposits, and also borrowings. Another thing that's been fairly interesting is, given the liquidity environment, very few banks at the moment have large concentrations of CDs or broker deposits or FHLB borrowings, because many of them have been so awash in liquidity that they've been able to pay them off. So what we have actually is a fairly one-sided rate mark on the asset side of the balance sheet, with the loan rates and the AFS available for security rate marks. So those have recently been driving book values down and increasing tangible book value dilution, but also increasing buyers' earnings accretion on after the deal closes as those rate marks amortize. So, I think one key thing to think about here is, when you're a buyer and you're evaluating a deal, is how does that affect our tangible book value earn back period? And the tangible book, so as a buyer, you think about your upfront tangible book value dilution, and you want to say, okay, well, that's the cost that my shareholders are paying day one for this transaction. It's the amount that our book value has diluted. What they're getting on the back end is this forward earning accretion. And how long does it take for that, payment upfront, that book value dilution, to be earned back through higher earnings accretion on a go-forward basis? And then I'm going to benefit further from that, additional earnings accretion and earnings multiple. And the things that will affect from rate marks, how the earn back period is affected, is the upfront. Julian, could you please go to the next page? Is the upfront book value dilution that's incurred, and then the period over which that rate mark is earned back. If it's a 2 to 4 year earn back or life of the AFS portfolio, or then it's not going to be terribly impactful to the earn back period of a 3 year earn back period without the rate mark. If it's a 10-year period over which that upfront dilution is going to be earned back, then it's going to push your earn back out pretty significantly, and a buyer is going to look a lot less favorably on that than they would now. I would say than they would a 3 to 4 year amortization period. So not all rate marks are created equal. I think a lot about the securities, the duration of the securities that is within the portfolio that's being marked will go into how long it's going to take to amortize that back, and that's something that will be considered and will affect it. But I think conceptually, if you have fairly plain vanilla securities in your AFS portfolio, if your rate mark on your loan portfolio is within has a duration within a reasonable time period, then it's fair to say that because that dilution that's incurred up front will be guaranteed to be earned back within a period of time that's not going to terribly alter our earn back period, the risk of those marks should be viewed differently than the risk of upfront tangible book value dilution from things like credit mark or things like contract termination payment, when you're depending on the operating earnings of the bank that you're buying to recoup those losses. And so you've seen that differentiation start to happen. If you go to the next page, please, Julianne, with certain acquisitions that have been announced since the end of the year, right? So for instance, these are just 4 samples. If you look at the top, you have First Commonwealth and the Centric deal, where they announced, as you go kind of from left to right, you have the announced date, then you have earnings accretion. GAAP, it was 5%. So GAAP, that would include the amortization of the rate mark, right? So they had a fairly large rate mark up front, and because that rate mark amortizes back, their earnings accretion is 5%. However, if you were to back out the earnings accretion from the rate mark, then their earnings accretion is really only 2.6%. However, when you think about tangible book value dilution, when you include the rate mark, it's 3.1%, right? So you can see you have 3.1%. It's dilutive up front, but the earnings accretion is 5% per year after. If you exclude the rate mark, the upfront dilution is only 1.5%, but it's lower forward earnings accretion at 2.6%. And then you can see here on the dynamic of what happens with that earn back period, right? When you look at it from a GAAP basis with higher upfront dilution, but also higher earnings, it's 2 years. And if you think about it without the rate mark, so lower dilution, but lower earnings, it's 1.4 years. So what this tells me here, right, is that they were probably amortizing that rate mark around over 2 to 2.5 years, which is why it pushed it from 1.4 to 2 years, right? And you've been seeing more deals get announced that way, where they bifurcate these deal metrics that people try to operate within, because frankly, there's zero risk associated with these rate marks. It's just an accounting adjustment, and then the earnings are guaranteed. Whereas on, if you look at the excluding rate mark here in this first example, where it's 1.5% and 2.6, that 1.5% upfront dilution, that's a given. That's a known. You're going to take that dilution because it's a difference between where your stock price trades and what you're paying, credit mark, and deal costs, right? So that that's going to be that 2.6%. That's gonna, there is some risk to that, right? Because you have to be able to execute on the cost savings that you're going to get. You have to be able to be confident that you budgeted the seller's earnings forecast appropriately. But the 2.4% between that percent of earnings accretion that comes from the AOCI mark, that's guaranteed. There's no risk to that. So more and more buyers, I think, are coming forward and thinking about this and trying to bifurcate it. And my view is that for the buyers that are able to do this and get comfortable with this, they have an advantage of being more competitive bidders today than others that are more worried about what's conventional, because those others may miss out on some deals where they could be competitive, but they're kind of stuck in the ways that were, for good reason, applicable in 2021, but not so much today.
Reid, these are great points. We have questions
Okay.
for you. We only have a few more minutes. Is
Sorry.
it okay? I'm going to stop the screen share if that's okay. But
Sure.
if you want to, we can pull it back. So I just want to get to the questions. It's fascinating. So let's see. Warren had asked that. Actually, Warren, let's ask about the credit unions at the end, if that's okay. Well, actually, it's an interesting point. So Warren's asking about the trend of credit unions buying banks, and it is an interesting question if the credit unions care as much about AOCI marks as the banks who have public shareholders need to.
I can tell you that my general view is that the credit unions don't really care, and they don't have anyone to answer to with regards to financial metrics, right? So meaning the earnings accretion, the book value dilution, and those things, they're non applicable to credit unions because they don't have shareholders. I think what the credit unions really focus on is pro forma capital ratios at closing, which makes this a very good question, because these higher AFS marks will impact what the pro forma capital ratios for credit unions would be at closing. So yeah. I would say that from a capital ratios perspective, they should care, but I don't know if they do.
It's different, right? It's good. Ed Frazier asked about if the decline in tangible book is mostly from the mark to market in available for sale as opposed to the held to maturity. I believe that's the question. And it raises an interesting question about in the K's and Q's, the fair value versus carrying value table. Really where you're just seeing security marks, maybe some loan marks, then the deposits don't seem to be reflecting their fair value, which their value is increasing as rates go up. So I think his question was, our tangible book, is tangible book markdowns on the, what about in the held to maturity book, I think.
So the answer to the question is yes, it's being affected by the AFS portfolio. The held to maturity, so the AFS portfolio is what gets marked to market kind of each reporting period, right? And the volatility that you'll see in tangible common equity is from that. When securities are moved or included into the held to maturity portfolio, which I believe, and Matt, I'm sure you can answer this question better than me, is about 5% of securities, like industry wide, if that. When it gets moved into there, that the purpose of moving it into held to maturity is to reduce that volatility and change. You would then, if something's marked at, if it's $100 bond and it's marked to $90 through the AFS portfolio, and you decide that you're going to move it into held to maturity, you move it in at 90, but then it stays there. Matt, is that accurate?
Yeah, that's accurate. And I think, the shorter answer is that the flows in book value that we've looked at for community banks are going to be earnings and AFS volatility. Those are the biggest drivers of the tangible book value growth, unless you're raising capital and obviously dividends would impact that as well. But when you look at the math, and just look at TCE changes, it's going to be, whatever our returns were less whatever impacted from the OCI as impacted by AFS. And page 11, I don't know if we need to go there, but page 11 shows those trends for the industry as a whole and shows how we got to Reid's 10% decline. We had a 10% decline in book value through the first half of the year. We had, essentially 5% returns, and those were completely wiped out 3x by what happened out of the bond portfolio. So essentially 3/4 of earnings were wiped out due to what happened in the bond portfolio degradation in value.
Well, I am so sorry. Well, we're going to move on to the next bank presenting. We ran out of questions. We ran out of time, and there are a lot of great questions. So we will be getting these to you and getting the answers to everyone we can identify. It is at the end. It's a good point that the deposits are not really getting their due. They're not getting their markup. It seems
it's a travesty.
Right, in M&A or in the reported gap, filings. But very good. Thank you, Reid. Thank you, Matt, so much. Really appreciate it. And we're going to bring on Bankwell, if that's all right, and we'll follow up with you. Thank you so much.
Thanks, everybody. Bye.
Thank you.